You think a financial crisis starts with a stock market crash? That the first sign of trouble is a sea of red on your screen with panicked commentators shouting about the Dow plunging? That's not the beginning. That's the final scene. That's the big explosion at the end of a movie that started months, maybe even years earlier. The real story, the one that actually matters, begins silently. It doesn't unfold on the trading floors, but deep inside the hidden architecture of our financial system, in the plumbing, the pipes and valves that carry trillions of dollars around the world every single day. By the time the news starts reporting on a crisis, the smart money has already seen the leaks. They've read the pressure gauges, made their moves, and battened down the hatches for the storm they knew was coming. The stock market crash isn't the warning, it's the confirmation that the system has already broken. Most people are watching the weather report. The insiders are watching the barometer. In this video, we're pulling back the curtain. We're going to ignore the flashing lights of the stock market and take you down into the engine room. We'll show you the real indicators, the silent warnings, and how a financial crisis actually begins. For most people, the economy's health is measured by a few simple things. We turn on the news and hear the S&P 500 is hitting all-time highs. We see headlines celebrating low unemployment and big corporate profits. Everything looks strong, stable, even prosperous. This is the gleaming facade of the financial system, the part they want you to see. It's reassuring, it's optimistic, and it's often dangerously misleading. Relying on the stock market to signal a crisis is like waiting for the smoke alarm to go off to realize the house is on fire. In reality, the fire started with a faulty wire in the basement walls long before the smoke ever reached the detector. The stock market is a lagging indicator. It measures sentiment and emotion, but it's often the last to price in a deep structural problem. It's a great barometer of psychology, but a terrible predictor of systemic failure. Think of the global financial system as a massive, intricate skyscraper. The stock market is the glittering penthouse lobby full of activity, bright lights, and the buzz of commerce. It looks magnificent, but from that vantage point, you never know if the building's foundational pillars were cracking or if the plumbing was corroding from the inside out. When a crisis begins, it doesn't start in the penthouse, it starts in the sub-basement. The 2008 financial crisis is the ultimate case study. The US stock market actually hit an all-time high in October of 2007. By all public accounts, the system was solid, but the real crisis had already started more than a year earlier. The plumbing was groaning. The foundation was fractured. The housing bubble had peaked, and the complex derivatives built on shaky mortgages were starting to go bad. The stock market crash wasn't the cause of the crisis. It was a symptom of a disease that had been quietly spreading for years. To be fair, the crash then created its own devastating feedback loop, eroding bank capital and shattering confidence, which only accelerated the panic. It was both a symptom and an accelerant. The spectacular collapse of a building whose foundation had already turned to dust. So, if the stock market is the wrong place to look, where do we find the truth? We have to leave the public lobby and take the service elevator down to the sub-levels of the financial world. We have to look at the plumbing. Now, when I say financial plumbing, I'm not talking about your stock trading app or your 401k statement. I'm talking about the network of markets that banks and other giant financial institutions use to fund themselves every single day. These are the channels that move liquidity, the lifeblood of the economy, from those who have it to those who need it. And the most critical part of this engine is a market most people have never even heard of, the repo market. Repo is short for repurchase agreement. In simple terms, the repo market is the global financial system's ultimate pawn shop. It's where banks, hedge funds, and other major players go for extremely short-term loans, usually just overnight. But instead of pawning a watch, they pawn their best assets, US Treasury bonds. A bank can hand over its treasuries as collateral to get cash to meet its daily obligations. The next day, it buys back its treasuries and pays a tiny bit of interest. This is supposed to be the most boring, safest corner of finance. The loans are backed by the safest assets on earth. It's the core mechanism that allows the gears of the entire system to turn smoothly. But what happens when the pawn shop suddenly slams its doors shut? What happens when the system's grease turns to glue? We got a terrifying glimpse of this in September of 2019. In a move that shocked financial experts, the interest rate in the repo market suddenly and violently spiked, shooting up to as high as 10% in a matter of hours. This was the plumbing freezing in real time. For reasons still debated today, there was a sudden cash shortage, and banks began hoarding what they had. They just stopped lending to each other. The panic was so bad that the Federal Reserve had to jump in for the first time since 2008, pumping hundreds of billions of dollars into the market just to get the pipes unclogged. To the public, it was a tiny news blip, but to those watching the plumbing, it was a 5-alarm fire. It was a clear signal that the system had become fragile, with hidden stresses that could cause it to seize up at any moment. It was a warning shot. Long before the plumbing freezes, it starts making strange noises. It sends out signals that pressure is building. These signals don't appear on cable news, they show up deep inside the bond market. The market often called the smart money. And the single most powerful, historically accurate warning is the inversion of the yield curve. To get this, you first need to know what a normal yield curve looks like. In a healthy economy, if you lend money to the US government, you expect a higher interest rate for a longer term loan. A 10-year bond should pay you more than a 3-month bill. That makes sense, right? You're taking on more risk for a longer time, so you should get paid more for it. A graph of these yields from short term to long term normally slopes up. An inversion is when this relationship flips upside down. It's when the yield on a short-term bond becomes higher than the yield on a long-term bond. Just think about how bizarre that is. The market is basically saying the immediate future is so risky that it demands a higher payment for a 3-month loan than for a 10-year loan. It's the bond market screaming that there is serious trouble dead ahead. It's a vote of no confidence in the near-term economy. Why does this matter so much? Because an inverted yield curve is one of history's most reliable recession predictors. While no indicator is perfect, yield curve inversions have preceded the vast majority of US recessions going back decades. It's arguably the financial market's loudest alarm bell, but one that very few people are listening to. For instance, a key part of the yield curve inverted back in 2006, well before the 2008 meltdown. It inverted again in August of 2019. Now, the recession that followed in 2020 was obviously triggered by a global pandemic and lockdowns, an outside shock no economic model could have seen coming. But the inversion still correctly signaled an economic downturn was on the horizon. More recently, starting in mid-2022, we saw one of the deepest and longest yield curve inversions in modern history. It was the bond market signaling with huge conviction that the Fed's aggressive interest rate hikes to fight inflation would eventually break something, forcing them to cut rates later. It was the smart money pricing in a future emergency. An inverted yield curve is a massive warning flare. But the pros don't stop there. They zoom in looking for specific cracks spreading from the government bond market into the private sector. They look for the transmission of fear. The next indicator is credit spreads. If the yield curve is the system's blood pressure, credit spreads are its cholesterol reading. A credit spread is just the difference between the interest rate on a risk-free government bond and a corporate bond. It's the extra cash investors demand to take on the risk that a company might go bankrupt. Imagine you're lending money to two friends. One has a perfect credit history, the other has a much spottier record. You'd lend to your reliable friend at a low rate. For your other friend, you demand a much higher rate to compensate for the risk. That difference is the credit spread. When credit spreads are tight or narrow, investors are confident. They don't demand much extra compensation. But when spreads start to widen, it's a sign that fear is creeping in. Investors are getting nervous that companies will struggle to pay their debts. Widening spreads are a direct real-time measure of rising financial stress. But we can go even deeper. The most forward-looking analysts watch indicators that build up over years. For this, they turn to the research of the Bank for International Settlements, or the BIS. Based in Switzerland, the BIS is basically the central bank for all other central banks, and they've done groundbreaking work on early warning signs. Two of their most powerful are the credit to GDP gap and debt service ratios. The credit to GDP gap tracks how much debt is held by households and corporations and compares it to the size of the overall economy, GDP. When private debt grows way faster than the economy that's supposed to support it, it creates a gap. The BIS found this gap is one of the single best predictors of a banking crisis, often flashing red 2 to 3 years in advance. It's a measure of just how much weight has been piled onto a bridge. Before 2008, this indicator was screaming red in the US and other countries. Then you have debt service ratios, or DSRs. This measures how much of a household's or a business's income is being eaten up just by making payments on their debt. When DSRs climb to dangerous levels, it means there's no room for error. Any small shock, a lost job, a small dip in income can trigger a wave of defaults. There's just no buffer left. These BIS indicators aren't crystal balls. They're more like a forecast that shows a 90% chance of a hurricane. They tell you the conditions are ripe for a disaster, giving you a heads up years in advance, not days. They are the signs the smart money watches to know when the party's ending, long before the music stops. So we have a weird signal from the bond market. We have rising fear in the corporate debt market, and we have a system loaded with historic levels of debt. These are the dry ingredients for a disaster. All it needs is a spark, the failure of a bank, a geopolitical event, or just enough investors, realizing the game is up. This is how the silent leak becomes a catastrophic flood. It almost always happens in the same sequence. First, the funding markets freeze. The repo market, that essential plumbing, seizes up. Trust vanishes. Banks stop lending to each other and hoard cash, fearing their counterparties might fail. The grease that keeps the whole machine moving is gone. Second, this triggers forced selling of safe assets. Institutions that relied on that overnight funding are now desperate for cash. To get it, they have to sell their best, most liquid assets, U.S. Treasuries. This creates a terrifying, unnatural situation where the price of the world's safest asset starts falling during a panic. This just magnifies the fear. Third, the panic escapes the plumbing and hits the real world. This is the credit crunch. Banks, now in survival mode, slam the brakes on lending to everyone. For families and business owners, this is where financial stress turns into layoffs, tighter credit, and sudden difficult decisions. That small business loan to make payroll, denied. That mortgage to buy a house, canceled. Credit, the lifeblood of the economy, is cut off. Economic activity grinds to a halt. And fourth, only now do we see the spectacular stock market crash. With a recession now a certainty, the headline indices finally plummet. This is when the public narrative suddenly flips from the economy is resilient to emergency and bailout. This cascade reveals the truth. The stock market crash wasn't the event. It was the aftermath. It was just the scoreboard reflecting a game that was already lost. Let's quickly map this onto the 2008 crisis. The plumbing was already stressed for years, with the BIS's credit to GDP gap screaming red from the housing bubble. The first silent warning appeared when the yield curve inverted in early 2006. The plumbing began to leak by summer 2007 as credit spreads blew out and mortgage-backed securities markets froze solid. The rescue of Bear Stearns in March 2008 was a major fire in the engine room, yet the stock market was still far from its bottom. The cascade became a flood in September 2008. Lehman Brothers' failure triggered a complete loss of trust, froze the global funding markets, and brought the entire system to its knees. Only then, after the plumbing had catastrophically failed, did we get the final act everyone remembers, the historic stock market crash. The crisis didn't start with Lehman. It was one of the last violent consequences of a problem years in the making. Financial crises don't start with a bang. They don't begin with a TV personality shouting or a stock index falling. They begin with a whisper, a silent creeping sickness in the unseen plumbing of the financial system. They begin with a bond market pricing in a darker future and a dangerous pileup of debt that makes the whole structure brittle. By the time the crash makes headlines, the real story is already over. The point of knowing this isn't to be afraid, but to be clear-eyed. It's to give you a new lens to see the world. Now you know where to look, not at the shimmering facade, but at the foundations. Not at the noisy stock market, but at the quiet, powerful signals coming from the bond and funding markets. This knowledge lets you separate the signal from the noise, understand how risk really works, and see the world not as the headlines portray it, but as it actually is. Understanding this doesn't make you smarter than the market. It makes you calmer than the crowd. If you found this look into the real mechanics of our financial system valuable, and you want to keep learning about the hidden forces that shape our world, make sure to subscribe and hit that notification bell. And now I've got a question for you. Now that you know about these early warning signs, are there any indicators that you're watching more closely? Share your thoughts in the comments below. I read everyone.